Hey everyone, welcome back to Corporate Decoder. Today, QuasarEdge Acquisition Corporation just filed a Form 8-K announcing their initial public offering, and I am spotting a key detail about share structure that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about a company going public, and we will break down exactly how much cash they are raising and what that means for the structure of the company. So what we have here is a very standard report for a company called QuasarEdge Acquisition Corporation that is essentially a shell company, or what is often called a special purpose acquisition company, a SPAC. These companies are created with the sole purpose of raising money through an initial public offering, or IPO, to then acquire or merge with an existing private company. The report officially states that the earliest event reported happened on the 13th of April, 2026. This is the date when things started getting really official for their public debut. The company itself is QuasarEdge Acquisition Corporation. Their goal here is to go out, find a business to buy or merge with, and that will be the actual operating business that people eventually invest in. They are incorporated in the Cayman Islands, which is a common practice for these types of companies. Their filing number is 001-43013, and their IRS employer identification number is not provided, which is also pretty standard at this stage. Even though they are incorporated in the Caymans, their principal executive offices are located right here in the United States, in New York City. You can reach them at this number if you need to. Now, this part is critical for understanding what investors are actually buying. They are registering three main types of securities on the New York Stock Exchange. First, we have units. Each unit is not just one share, but a package deal. It includes one ordinary share, which is a basic share of ownership, and a right. This right is interesting because it gives the holder the privilege to receive a fraction, specifically 1/4 of another ordinary share at a later date. This is often tied to the company finding and completing its main business acquisition. Then you have the ordinary shares themselves, which are the basic building blocks of ownership in the company. And finally, the rights are also listed separately, meaning you can technically trade just the right to get that future fraction of a share. QuasarEdge Acquisition Corporation is identifying itself as an emerging growth company. This means they can take advantage of certain relaxed regulatory requirements for a period of time, which is fairly common for companies going public this way. This section details the actual completion of their initial public offering, and this is where the money starts coming in. On the 16th of April 2026, QuasarEdge Acquisition Corporation bought and sold 10 million units to the public. This is the big day for them. Each unit was priced at $10, meaning they brought in a massive $100 million in gross proceeds before any fees or expenses. That is a huge amount of money to start with. The company that helped them sell these shares, known as the underwriter, has an extra option. They can buy up to an additional 1.5 million units if there is a lot of demand, or if they need to make sure everything is bought up. This is a common way to boost the total funds raised and manage the stock price right after it goes public. Polaris Advisory Partners, a division of Kingswood Capital Partners, LLC, was the main firm handling this sale. They officially agreed to this on the 14th of April, 2026. This is the formal contract that lays out the details of the underwriting agreement. It is like the blueprint for how the shares were sold. The rights agreement is important because it sets the rules for those special rights we talked about earlier, the ones that can be exchanged for a fraction of a share. Continental Stock Transfer and Trust Company is the agent making sure all this happens correctly. This trust agreement is a big deal for SPACs. It explains how the $100 million raised in the IPO will be held. Typically, most of the money raised in an IPO for a SPAC is put into a trust account. This money is meant to be used for the company's eventual acquisition. It is managed by a trustee, in this case, Continental Stock Transfer and Trust Company. The registration rights agreement is about ensuring that certain shares, often those held by the founders or early investors, can be easily registered and sold in the public market later on. This agreement concerns the sponsor, which is Equinox Capital Solutions Limited. This is the entity that typically provides initial capital before the IPO, often in exchange for founder shares and warrants. These are standard indemnification agreements. They essentially protect the company's directors and officers from personal liability for actions taken while serving the company. It's a way to ensure qualified people are willing to take on these roles. This section covers any shares sold without being officially registered with the SEC, usually to private investors. Right when they did the big IPO, they also did a private sale or private placement to the sponsor, Aspira Capital Consulting Ltd. They sold 285,000 units at the same $10 price, bringing in an additional $2.85 million. This shows the sponsor's belief in the company. These private units are the same structure as the public units, one share and one right. The key difference is that these were sold directly to the sponsor and did not involve the fees associated with a public underwriting. This confirms that the sale was made under an exemption from public registration, which is common for private placements to sophisticated investors like a sponsor. This part is about the people running the show, the management and board of directors. So on the 13th of April 2026, 3 new directors joined the board: Wei, Victor Zhang, Daniel M. McCabe, and Ping Zhang. This happened right around when their IPO registration was finalized. Qi Gong is the veteran here. She has been the chairwoman, CEO, CFO, and a director all the way back since the company was first created. She's clearly the driving force behind this SPAC. The new directors, and likely Qi Gong as well, will be reimbursed for any expenses they incur while working on behalf of the company, like traveling to investigate potential merger targets. This just ensures they don't have to pay these business expenses out of their own pockets. This section talks about changes to the company's foundational legal documents. On the 13th of April 2026, they updated their core governing documents. Think of this as revising the company's constitution to fit its new status as a publicly traded entity. The actual document detailing these changes is filed as an exhibit and referenced here. It outlines the fundamental rules of how the company will operate. This is a catch-all for any other significant events that don't fit neatly into the other categories. This is a very important number. As of the 16th of April 2026, a total of approximately $103.5 million from the IPO and the private placement money was put into that trust account. Remember, they raised $100 million from the IPO and $2.85 million from the private placement. So this $103.5 million figure represents the net amount after some initial costs. This trust account is essentially the war chest for their future acquisitions. They promise to provide a more detailed audited balance sheet soon, showing exactly where all that cash is. Finally, they have included press releases about the IPO pricing and the closing as exhibits. These are for public announcement and generally contain positive framing of the company's progress. Here we see listed all the exhibits that were filed with this report. It is a bit like the appendix of a book, providing the actual documents that support the claims made in the report. We have the underwriting agreement, the company's governing documents, the rights agreement, trust agreements, and more. The share escrow agreement is another crucial document for SPACs. It will likely outline how certain shares, especially those held by insiders, are held in escrow and released based on certain conditions, such as the completion of an acquisition. And as mentioned, these are the individual indemnification agreements for each of the directors. These press release exhibits are essentially the company's official announcements to the world about their IPO. They are designed to be positive and informative for the public and media. This second press release confirms the successful completion of the IPO. And here is the signature block, confirming that the report has been officially submitted. Qi Gong, the CEO, has signed off on this report, confirming its accuracy on behalf of QuasarEdge Acquisition Corporation. So, what is the story here? QuasarEdge Acquisition Corp has successfully completed its IPO, raising a cool $100 million plus some change from their private placement, totaling over $103 million to be held in trust. The key players are in place with a board and CEO, and the legal framework is set up for them to go find that target company. Remember, the ultimate success of a SPAC like this hinges entirely on how well they identify and merge with a quality operating business. This filing is just the beginning of their journey to potentially become a real operating company. The risk I am watching is their ability to find a suitable acquisition target that can grow and prosper under their ownership. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.